Hello, everybody. Thank you for joining us for this morning's webinar. We know that it's been a while, so thank you for taking time out of your day to join us. Just to let you all know, we had to get a new mailing list, and so if you want to continue receiving our emails and not have it delivered, hopefully to your junk or spam folder, then you need to join our new mailing list. And just remember that you need to opt in once you receive the confirmation email. So once you sign up, you'll be sent a confirmation email that you want to opt in. Please make sure that you do that last step, because if you don't, chances are it will be delivered to your junk or spam folder, or who knows what else. But you can see that we have it currently as a pop-up on our website right now. Also, you can do it in this black strip part of our website. And hopefully, most of you got the email about the announcement of the fall intensive. It's going to be from October 16th to November 15th. And this is going to be our final long format intensive, meaning that Jim is still going to be doing courses, but in a more shorter format moving forward, because, 4.5 weeks, quite a long time. So if you haven't been with us for a while, you might want to consider coming back for this last one. And if you've never taken intensive before, you need to make sure that you have the prerequisite requirement of the Foundation and Application of the Market Profile e-course. You need to have that in order to be able to join us for a live intensive. And right now, because it's the early bird enrollment period, we do have discounted bundles. So if you haven't completed the Foundation e-course yet, then you can get a great deal by purchasing this bundle right here, the Foundation e-course with the intensive bundle. What you'll also notice is that we have what we call our triple bundle. If you are interested in all three of the courses that we have, meaning the Foundation e-course, the intensive, and the advanced nuances e-course, you can get a great discount for purchasing all of those. And then for those of you who are already qualified to join us for an intensive, because either you've been grandfathered in because you've taken a full intensive in the past, or you've already done the foundation previously as well, we do have the intensive and advanced nuances e-course bundle as well. If you have questions about if you're qualified to join us for the intensive, like I said, you have to have the prerequisite requirement of the foundation e-course, or if you have done a full intensive with us in the past, then you're grandfathered in to be able to take an intensive with us. But you have to be verified in order to be able to do that. Anybody who signs up for the intensive without meeting one of those two requirements is not allowed, and you'll end up getting refunded minus credit card fees that we cannot recover. So please, if you've got any questions, you're not sure, better to contact us before making a purchase and me having to come after the fact to contact you and have that discussion with you. Okay. I don't know if you had anything else to say about that, Jim, but the schedule is available on our website, so you can see all the special presentations and the amount of time that we'll be spending with you, which is over 61 hours for this intensive, and I have no doubt that we'll probably get a session added or two. You'll notice all the timings here are in Eastern. And all of the webinars are recorded in case you can't attend one, or maybe you have a day job that might get in the way, or if you live in a time zone that it's not suitable for you to be able to join us for every single webinar. So just know that they're all recorded so that you can go back and rewatch them, and you get access to materials for 1 year after the course finishes so that you have time to go back and review everything. Okay, so you can find all the details by going to our website, jimdallentrading.com courses, and you'll see the intensive featured up at the top. And then if you scroll down, you can click on each individual course to get more details specifically, and then all the bundle offerings. And these bundle offerings, the current sale pricing for this early bird enrollment is until, I believe, Sunday, September 8th. Is when this pricing will end, and then it's going to inch up. So purchasing early always yields you the best price. Okay, Jim, anything to add before we move on?
No, let's go on.
Okay, let me give you the screen then. There you go.
Okay. There's not a lot to say about markets this morning because they're balanced, but I'm going to cover a topic that I think is probably the most important topic traders can ever deal with. As if you've ever taken intensive, you know we do 2 book reviews. One of the books that we're going to review in the current intensive is called Chatter by Ethan Kross, Kross. The subtitle is the Voice in Our Head and Why It Matters and How to Harness It. One of the things that we always say is most people that really understanding about trading, they are just simply looking at the market and looking for places to buy, sell, etc. The comment that I've always made is the real market we're trading is ourselves. We are very complicated. Most of the errors that we make in trading are self-induced. I think of all the books, and I do a considerable amount of reading, particularly when it comes to self-understanding, but I think that Chatter, The Voice in Our Head and Why It Matters, is probably one of the most important books I have ever read on how I think personally and how to reflect on the market. So this is whether you're going to take an intensive, and we're going to review this book, or whether you're not going to take it. I just think it's just a great book because that voice in our head, it is amazing how much damage it can do to us from time to time. Okay, what we're starting here is, in front of you is a daily bar chart. As you can see, and if you've read our weekend pieces, the market emotionally had a huge break, and it was well overdone to the long side. Inventory had just gotten ridiculously long. And of course, it was long by weaker hands almost all the way through. I've seen no indication of any serious longer term money in this market. So the market was set up for this kind of a liquidating break. And this is what happens when markets get ahead of themselves. It takes some kind of catalyst in order to trigger that. It left an excess low, and then the market ground back up to just under where the high had been. Now, it didn't fill this gap. This gap is, of course, the upper reference. But what you have is, if you count this day, you have 1, 2, 3, 4, 5, 6, 7-day balance. Balance is the market's way of telling you that it needs more information before it makes its next directional move. It's just a market that's into short-term balance. And when you see this, almost every trader I ever talked to has some kind of longer-term bias. The market's going up, the market's in a bull market, it's a bear market, etc. And I've noticed there's quite a change as I listen to some of the commentators on the TV. We're starting to get, just in the last couple of hours, I've heard a tremendously bullish presentation, and I heard a tremendously bearish presentation. So we're starting to get more of a variance in what people are thinking out there in the market. And that's an indication that the market is also an indication that the market's coming into short-term balance. And that's where we are right now. This is what you have. Remember, the balance trading guidelines. The market, if the market remains in balance, all it's doing is tightening the balance itself. We had what was the question that we got this morning? Can you read that?
Sure. Somebody's asking, how do you use market profile given the current market scenario that the ES makes extreme intraday highs and lows without a major catalyst or anything else?
Okay. And it's actually it's a misunderstanding. It starts with a misunderstanding of what the market profile is. We are not market profile traders. We are discretionary traders. All the market profile is a distribution curve. It organizes the market's continuous two-way auction process. It doesn't tell you to buy, it doesn't tell you to sell. All it does is organize the information. When you're looking at that question, when there's nothing significant on the highs and the lows, that's just an indication of a market that's in short-term balance. And that's very consistent with what you're seeing here. So we said when the market's within short-term balance, in there, it's telling you it wants more news before it makes its next directional auction. Now, the market's all geared up for NVIDIA earnings this evening. Maybe that's the catalyst that breaks it out of this. Maybe it's not. I don't know. When you have a balance, you want to go with a breakout from that balance. That is the indication of a market starting a new directional move. If the market attempts to break out to the upside or to the downside and it fails, so you get a failed breakout to the upside or downside, then you want to fade that or go against it. If you have a downside breakout, for example, and it fails to carry through, the odds are that the market will attempt to rotate back up to the upper extreme. Conversely, if you attempt to break out to the upside and it fails, the odds are that it will attempt to rotate back down to the lower end of the balance. If the market does attempt to break out to one area or the other and fail, and then return to the opposite extreme, you reapply the best trading guidelines again as you reach that extreme. There's really nothing more complicated to what's going on in this market right now. I know people, have almost everybody has a bias, and biases really kill us as traders. The most important thing I'm always trying to do is I'm a short-term trader. As a short-term trader, I'm trying to stay objective to what is the market doing. And when you look at the bar chart in front of you, 1, 2, 3, 4, 5, 6, for 7 days, it's doing nothing. It's in short-term balance. So it's very consistent that, you get no carry through the upside, no carry through the downside. Okay, I mean, it's no more, I don't have any more to say than that. It's just what it is. And don't make it any more complicated than it is. Relax, put your biases aside. Biases kill us. Biases kill us. As a lot of you know, I've just turned 84, and I hate to think how many biases I've had over the years that have been incorrect and how expensive it's been. Okay, Jen, let's take some questions.
Okay, we've got more than one person asking this question or similar. What indication do you look to know if longer term money is involved in the market? Obviously, that's a common question that we get. The other version of the question was, how do you see participation of longer term money in the market? What are you looking for in the profiles?
Okay, well, first of all, when you're looking, you see the way the market broke and the market came back and then it came to a standstill. This is a pretty good idea right here. Just perspective that there is no longer term money in the market. That it's just neutral. When you look on a daily basis, on a daily profile, One of the things people do, they continually search for and think they see longer term money in the buy side or the sell side. And it hasn't been there for a considerable period of time. But one of the things that you'll notice when there is no longer term money in the market, the market will continually stop and start and show, acceleration or directional change from exacting references. Those references, for example, look at the G period low early last night, exactly at half back. When you see it exactly at half back, that is not where longer term money gets involved in the market. This is an indication that it's shorter term money. You see yesterday's high. There's no excess on yesterday's high. That's an indication that there were no longer term sellers. It's just that the shorter term traders just got too long. Overnight, you just looked above this, came back in. Again, an indication of pretty much nothing but shorter term traders. Matching, when you take a look and you see the E and G lows match, that's an indication that's more than likely that's short-term buyers. L and M match, generally an indication short-term buyers. DI, all very similar, indication of short-term sellers. The exacting nature, the longer-term money is not exact. Their size is too big. Whether they're using algorithms to enter or exit the market, you don't get that exactness. The exactness comes from the behavior of short-term traders. They look at half back of the 30-minute period, half back of the overnight low, of the overnight range, half back of yesterday's range, previous highs and lows. It's a mechanical nature that we call them anchors. And anchors, they're nothing but they're psychological crutches that short-term traders use. That's the extent of the research. And for example, short-term traders love to buy lows and they love to sell highs because it's easy to see in there. So it's that behavior to ask yourself, what is happening in the market? Understanding that behavior of who you're competing against, how they're acting, is the best clue that you're going to have of who are you competing against. So many times people are they get it in their mind that they want to see long-term buyers or sellers. And if you want to see it, you'll probably see it, but it's not there. So it's important to be objective and to be able to read a market. And reading the market is understanding the behavioral characteristics of these short-term traders, and they tend to buy at exacting levels. Okay, what else?
Okay, and this is a question that we had more than one person also asking about. Basically asking, how do you know, if a breakout is successful or has failed? Like, do you judge that with time? How much room with price do you give? Those are the types of questions being asked around that.
Okay, and the answer is you have to be involved in the market. You have to see, are higher prices, let's say you're going to break out to the upside, are higher prices easily staying above the breakout high? Are higher prices bringing in more volume? Is the market elongating? It's those type of things that there's no simple answer to that question, but you have to be involved in the market every day in there. But you'll see it in volume, you'll see it in shape, and you'll see it you'll just get this feeling that the market there's really some buying there. One of the things that's more important to me is what doesn't happen. So many times people say, well, how do you tell? Well, the most important thing to me is, and you saw this yesterday, Anybody that's taken one of our intensives knows that we talk a great deal about tempo, which is speed or pace. And if you take a look in the market, when the tempo is trying to go up, particularly with the trend, and it just is slow, that is an indication that the market really doesn't have any buying power to it. Take a look at yesterday. There's, these highs, the tempo was just unbelievably slow. Did traders keep going back up there? Yeah, they like to go with, with what they think is the trend. But the tempo was unbelievably slow. And the tempo tells you that it's short-term traders. They're not being joined by longer-term traders. And the same thing happens on the downside. But it's more important to understand tempo is more important with the trend versus against the trend. Okay, what else?
Okay, another question is somebody's asking, what source do you use for volume when you're dealing with trading crude and gold?
When I'm trading crude and gold, I use futures volume. When I'm trading the ES, I use the NYSE volume as a proxy. One of the things, when you ask that question, one of the things that when I talk about using the futures volume, when the market, when you get a market that breaks, when you look at the volume here, white is the lightest, pink is the heaviest. I say pink is medium and red is the heaviest. So let's say, for example, I get a break, and it's mostly very thin white volume. That's usually an indication that the break was emotional and you're not going to get any follow through, and the market probably going to reverse. You get that break and you see the futures volume is red. It's heavy volume, and it builds. That's usually a better sign of continuation. Now, I haven't traded gold and crude in years, but that's what I did when I traded it. Now I trade mostly the ES, just simply because of my age, and that's what I use for teaching. Okay, but remember also, it's volume is one thing, but when you're looking at a distribution curve, which is what the market profile is, the shape is also informational. Let's take, for example, look at the break. Here's the break on the 26th, on Monday. Look at the shape. This is kind of like here's the B shape. There's the long stem and kind of like the letter B. That's an indication that it was liquidation, not a combination of liquidation and new money selling. Look at yesterday. There's your thin portion of the letter P and the letter P on top. So you got liquidation here, you got short covering here. It's just an indication the market got too excited, on the upside, too excited on the downside, and the market just still remains in balance. So remember that the market profile organizes the market's continuous two-way auction process. But when you're using a distribution curve, the shape or the structure of the distribution curve is also informational. Okay? Last question there, Jen?
Okay, somebody's asking, or more than one person actually, is what is acceptance then? Is it time spent or the amount of volume traded?
It's not a simple, again, you're looking for a simple answer. And as you can imagine, in trading, simplicity doesn't always exist. What you're looking to see, is it accepted over time? Is it accepted with volume? You're going to put in the tempo. So you go up and you make a new high, but the tempo is unbelievably slow. Probably low odds of continuation. Is the volume drying up? Not a good sign. You go up and you want to see the tempo being pretty good. You want to see the market show continuation in there. But looking for those simple answers is going to mislead you. The complexity Trading is complex, and it's not one single thing that's, in most cases, that are going to give you the answer. So much of that comes with experience, and you're not going to get real experience unless you do get involved in the market, so you do understand how the market is on a continuous two-way auction process. Okay, final question.
Yes. Okay, when the Fed cuts interest rates, could that be considered a deflationary event in the longer term? Could they be behind the curve?
The answer is, but when you get involved in those time of questions, that is not helpful as a short-term trader. When you start ruminating on those kind of questions, that is what leads you. That is what leads you to get your biases and really impact negatively your short-term trading. There's never a simple answer to those questions. You'll hear them debated and debated and debated. And you're so much better off. Look at the market. Take your answers from the market, and how does the market see it? Because the market, even if the market is, guess what? If the market's wrong, but it's going to interpret it positive and it's actually negative longer term, if you don't listen to the market, it's going to be one of these situations where you may be right, but you lost money, so you're wrong. Listen to the market, not to your biases. Remember, what I'm talking about here, short-term traders. Investment account, I may think differently. As a short-term trader, it's so relevant to listen to the market. Okay, let me say thank you very much. I hope you join us for the final long intensive. As you can guess, since I've done this for many years, I'm certainly will make an effort for it to be the best one we've ever done. Thank you very much, and hope to see you soon. Bye now.
Yes, and once again, just for people who weren't here early when the webinar started, you do need to have the prerequisite requirement of the Foundation and Application of the Market Profile e-course in order to join us for the intensive. Or the only other way is if you're grandfathered in because you have taken an intensive, a long form intensive in the past with us, and that we can verify it. So if you have any questions, better for you to contact us and inquire about if you're qualified or get any questions answered so that you understand before making the purchase. Please don't make that mistake, because then you'll be hearing from me to discuss about that. Okay, so thank you so much, and please be sure to make sure that once you opt into the new mailing list, that you once you get the email to confirm that you take that step to do that. Otherwise, chances are you won't receive our emails, or they might be delivered to your spam or your junk folder. Okay, thank you very much, everybody, and I look forward to seeing you at the next webinar. Thank you so much. Bye-bye.